While the market debates when easing will start, my next guests say it could be fast and furious when it begins, if history is any indication. Joining me now, Michael Schumacher is Global Head of Macro Strategy at Wells Fargo, and David Harden is CEO and Chief Investment Officer at Summit Global Investments. And Michael Schumacher, that sounds like you, if I'm not mistaken. You think we could be headed down a steep slope here soon?
Yeah, it's a good possibility, Kelly. So typically when a central bank, whether it's the Fed or the ECB or some other central bank eases, it goes pretty rapidly. Generally speaking, about 200 basis points in a year, so it's a pretty quick move. And I think it's interesting to consider the inflation backdrop as well. Inflation's moderated, but it's not actually low yet, so it's come off quite a bit. But that's really going to dictate a lot of the timing for the Fed. But when it does happen, we think it is pretty quick.
And when do you think it's going to happen?
Yeah, around the middle of the year, plus or minus. So whether it's May, June, July, it doesn't make that big a difference, frankly, but sometime in that general ballpark. So the Fed's got a lot of variables to consider. What it really wants, so we think, is a few more good inflation prints. Maybe it gets one tomorrow. Maybe it gets a few more over the next couple months. That'll really increase the comfort that inflation's not just down, but maybe it's out for a while. Then the Fed can come in. That's what we think it's looking for.
But in other words, you do think their reaction function really hinges on CPI, to some extent PCE. But if tomorrow's a little bit higher than expected, do you think that throws their timeline a few months further into question?
It makes it less comfortable for the Fed. It's interesting when you talk to clients out there and look at various forecasts, people are very much clustered thinking about core CPI. Either it comes in at plus 0.2 or plus 0.3 for December. No one says 0.4. So the consensus generally is call it 0.25. If you do get an upside surprise, that would be a bit of a shock. So I suspect you'd have the policymakers at the Fed say, maybe we didn't calculate it quite right. Maybe we've got to think about this going forward. The market would price for a much longer period, I think, in that event. The Fed may not actually change its tune too much. There have just been so many countercurrents out here to try and deal with for the Fed, but that would be a scary number.
David, what about you? Are you a little uncomfortable with the fact that we've had yields back up this year? Stocks are off to kind of a sloppy start?
I think it makes sense given the Santa Claus rally that happened, up 20% or more in many different asset classes. So taking some pressure off of the valuations is probably a good thing. In respect to the Fed and to the inflation, we do expect that inflation will either be in line or a little bit lower. And so I think it will go to this narrative of rate cuts, and I think that everybody expects that a little bit with the Fed. And if the markets have some geopolitical event, they can also help out with some QE instead of QT. So I think we're going to see some tightening continue to wind down and go into this rate cut environment.
Wait, so, and again, you know, we're talking on the one hand about how the rate cuts might not start imminently, but you're still talking on the other hand about how they're going to be necessary to support kind of the stock market's performance. And there are specific stocks, David, that you're a fan of. But if we have to push out rate cuts, does that make you nervous at all?
For me, yes, we have to manage risk for our clients, right? So every time there is something on the table, we need to analyze it and get our arms around every detail of it. And I think that's really, really important for investors to understand and to realize that risk is still on the table, though there's no sign of it in the VIX. There's no sign of it out there. The reality is it's there. So we have to understand that for sure. But I'm not really nervous about the rate cuts coming or not coming. I think if they do come, that's because it's a good scenario in the sense of inflation is coming down. And if they do come because the market does something that causes these rate cuts to come, quantitative easing to come, I think the Fed right now is the driver, and they're still behind moving the market up.